Good day everyone, my name is Marcus, and if you are new to the channel, welcome. If you're not, thank you so much for supporting us all this while. Just remember that every like and subscription goes a long way in supporting our production. Now, before we dive into today's video, have a look at these disclaimers before we proceed. Okay, so for today's video, we'll be talking about a very exciting topic, and that will be the future of China's IPO market. For those of you who are not familiar with China, basically they have been operating on the Shanghai Stock Exchange for the past few decades. But recently, the Chinese government has decided to go ahead with a plan to create the Chinese star market, which has been envisioned as a rival to the Nasdaq market. And the fundamental reason behind this would be there have been many unicorns emerging in China. For those of you who are unsure what a unicorn is, it is basically a startup with a valuation of more than $1 billion. If you don't know how big that is, just think of the startups that you see around you. For example, Airbnb, Grab, Shopee. All these are startups which have been hugely successful but have only managed to raise somewhere between 300 to 500 million. So for a startup to raise $1 billion and to go beyond $1 billion is really a big thing, which is why a special term has been given just to classify this company known as unicorns. Back to the topic, there have been many unicorns emerging in the Chinese market lately. For example, there is Ant Group, which is operated under the purview of Alibaba and Jack Ma, as well as China's ride-hailing service Didi Chuxing. All these companies are companies which have astronomical valuations and yet have decided not to list in the US market. That could be a mix of both regulatory as well as politically motivated reasons. China's star market has been gaining a lot of traction lately because of the return that investors have managed to get from the market itself. Ever since it was created last year, investors have really experienced close to 130% return in the same time period when Nasdaq has only managed to return around 40 to 50% of their gains. So it's definitely a force to be reckoned with, and it ties in with many analyst predictions that we could see most of our money in the Chinese market in the future rather than the US Nasdaq markets. It is not just the retail investors themselves, but many small startups in China are also rapidly trying to list on the star market in a bid to capitalize on the pre-existing overweight trend on equities in the global market. But that is not to say that the US stock exchange is dead. In fact, it is still hugely popular, being the center of the world's investment activity. We have seen 27 startups listing in the NYSE this year and 6 in the Nasdaq this year, which is still quite significant, especially if you're comparing to local markets like the SGX, where there's the definition of it being absolutely dead with only 1 or 2 companies listing over the span of a few months. Besides the overweight trend, another fundamental reason why companies like to list in the star market is because Chinese companies don't like the threat of delisting. For a perfect case study of this, look at the case of Luckin Coffee, where they were threatened with delisting by the Securities and Exchange Commission, especially after their share price kept falling below $1 per share after the fraud case involving their CEO. The threat of delisting is just something very significant for a startup because being forced to delist, you are essentially losing tons of investor money. All the money that institutional investors and retail investors have poured into your startup are essentially going to be gone if you are relegated to the pink sheets or the over-the-counter markets. So this is why many Chinese companies in fact will prefer to list on their domestic market, because they know that listing there guarantees them wider domestic demographic that they can tap into, as well as having a source of guaranteed funding from the Chinese people who will definitely support their own local companies over some American rival. Another thing to realize is that these Chinese companies are smart. Just because they list on the star market does not mean they are ignorant of the importance of the wider global market and the deep growth opportunities that overseas investors provide. And that is why they embark on dual listings in both the Shanghai Stock Exchange and the Hong Kong Stock Exchange. By listing on the Shanghai Stock Exchange, they are essentially accessing their domestic market, whereas the Hong Kong Stock Exchange is a more fluid stock market that international investors flock towards. So in a sense, this guarantees that they have the support of both the domestic and the international market, essentially killing 2 birds with 1 stone. Dual listing has its own problems as well. In many of the recent companies we've seen that have dual listed, there's a divergence in prices of both indexes. For example, Grade A stocks listed on the Shanghai Stock Exchange were reported to be priced up to 6 times more than similar companies on the Hong Kong Stock Exchange. So as a retail investor, you definitely have to be wary of such traps and ensure that you're getting a fair price for the value of the stock. Okay, so that concludes this week's video on the China's IPO market. I hope that you have one key takeaway from this video which you can share with your other friends. I've listed some resources in the video below which you can access. If you have any thoughts on the upcoming future of China's stock exchange, as well as any Chinese company stocks that you want me to go into, definitely drop a comment below. I'll try my best to do my due diligence. If you have any other questions, do drop a comment below. I'll try my best to answer all of them as well. Stay tuned for the next video and invest safe.
Ever since the day that you